Have you ever heard about market psychology? Market psychology can help us understand why people behave the way they do in financial markets. It is the study of human behavior and decision-making in the context of investing and trading. It plays a critical role in shaping market trends and determining the success of individual traders and investors. Market psychology is about understanding the emotions, motivations, and biases that drive individual investors and traders. It explores the psychological and social factors influencing their behavior and decision-making, such as fear, greed, and herding. Understanding these factors is essential to making informed investment decisions and avoiding common pitfalls such as overconfidence and irrational exuberance. Fear and greed can make traders to close the position sooner or later in the trade and not be bounded by their own trading strategy. One of the key concepts in market psychology is the idea of crowd behavior, or the tendency for investors and traders to follow the actions of others, even when those actions are not rational or based on sound reasoning. This often results in market bubbles and crashes, as investors buy and sell assets based on the actions of others rather than on fundamental value. Another critical aspect of market psychology is the role of emotions in investing and trading. Fear and greed are two of the most powerful emotions driving market behavior. Fear can cause investors to sell off assets at the first sign of trouble, leading to market panics and sharp declines. On the other hand, greed can cause investors to overinvest in assets that are overvalued, leading to market bubbles and subsequent crashes. Market psychology also plays a role in shaping market trends and determining the success of individual traders and investors. Investors and traders who are able to control their emotions and make rational, evidence-based decisions are often more successful than those who are driven by emotions and biases. In this sense, market psychology can be seen as a critical component of effective risk management and long-term investment success. Finally, market psychology is an ever-evolving field, and new insights and theories are always emerging. Some of the latest research focuses on the role of behavioral finance and the cognitive biases that impact market behavior, such as overconfidence, anchoring, and herding. By understanding these biases and how they impact investment decision-making, traders and investors can make better, more informed decisions and avoid the pitfalls of emotional and irrational investing. By doing your own research, you can identify when market psychology, like fear or greed, results in oversold or overbought conditions. You can then make contrarian trades, buying when others are overselling and selling when others are overbuying. Research can also help you jump on trades early but not chase trends after they've already gone past their fundamentals. In conclusion, market psychology is a critical field of study that can help traders and investors better understand the complex and often irrational world of financial markets. By exploring the emotions, motivations, and biases that drive market behavior, we can gain valuable insights into why markets behave the way they do and how to make better investment decisions. Do you want to know more about market psychology?